Calling Silicon Valley Clean Energy Finance and Administrative Committee meeting to order at 10:04. Regarding that, do you want to roll call?
Thank you so much. Chair Srinivasan.
Present.
Vice Chair Showalter.
Here.
Director Mohan.
Here.
Risto.
Here.
And absent, we have Director Scozola, but we do have a quorum present.
Thank you. First item on the agenda is the consent calendar. Approval of minutes of February 26, 2025 Finance and Administrative Committee meeting. Do we have any comments from the committee? Okay, in that case, we'll open it for public comment. Any member of the public can speak now. Is there anybody online?
No hands raised for this item.
Okay, thank you. That we close the public comment and then request a motion.
Move to approve.
Second?
Thank you. Roll call, please.
We don't have to do roll call.
Yeah,
So it's
we'll
resolved.
say aye. Voice vote.
Aye.
Any opposed? Abstain? No. Okay, thank you. That motion carries.
Thank you. Next on the agenda is CEO update.
I have no CEO update today.
Oh, wow, it's approximate duration 5 minutes. And then
Well, we have such a busy agenda today, so I thought I would give all my time to Amrit, the CFO, instead.
Sounds good. Thank you. It says public comment. Should we ask for public comments on CEO update?
We can.
Yeah, okay. We open it for public to speak on CEO update.
No comments.
Okay, we close public comment. Next on the agenda is recommend the Silicon Valley Clean Energy Board of Directors authorize CEO to approve or execute an agreement with firms providing services to initiate SVCE to execute its fourth prepay. Any report?
Okay. So, as you just heard from the chair, this is an action item. We're going to ask that you recommend the board approve these services and for us to initiate our fourth prepay. And I'm going to go through the prepay a little bit later in the presentation. So I'll give you an overview of the requests. We'll talk a little bit about some of our prior prepays. We'll talk about the exact contracts and consultants which we're seeking authorization. And then we'll talk about the savings, which is the fiscal impact, and then the next steps that we need to go through to execute the fourth prepay. So that's what's planned for today. And do we have, before I forget to acknowledge, we have Mike Berwinger joining us. He's from PFM Financial. He's been our municipal advisor for the first three prepays, and he will be also a municipal advisor for the fourth prepay. And he's here to take any questions that you may have of him. And as we go through the presentations, I'm sure questions will come up, so feel free to get some expert feedback and responses from Mike. Thank you, Mike, for joining us. Okay, so my slides here too. So the request is to basically execute gives the CEO the authority to execute 4. You'll see one of them is actually within the CEO authority limit. So let me clarify first. All of these contracts that we execute when we do a prepaid transactions, as we've done for the first 3 transactions, they're contingent on the deal being executed. So if we do not execute the deal, we do not pay any of these fees, with one exception, which is noted there, and I'll talk about that. So all the fees will be basically paid from the bond proceeds, and the savings that we will achieve will be net of these fees. So these are all contingent. So one could have questioned whether we needed an authority. This is how we have done our prepaid transactions in the past when it was new, And we've decided to continue with the practice that we kind of started with. And we also thought it would be a good time since the last prepay we did was a little bit more than a year and a half ago. The last prepay was January of 2024. So we thought it would be a good to come to the committee and the board before we seek your final approval, which is expected to be in August, which would actually be all the transactional details needed to execute their prepay. That's when we'll know the size and all there's countless numbers of contracts that get executed with that. That's when we will seek your approval as well as the board's approval. Now, one fee here, as I mentioned, is Moody's. So this is an investor credit rating fee. This, if once we initiate this, we do have to pay, even if the prepay transaction doesn't materialize. And therefore, we will not initiate that with them until we are actually ready to go to market and we have good certainty that we will wait for initiating with the credit rating agency until that time. And Morgan Stanley has a.
I was wondering, what's our credit rating now? And how is this credit rating different from just a regular credit rating that you sort of have? Like,
so our credit rating, S&P rates us as A and Moody's rates us as A3. So we have very good credit rating. This is credit rating of the bonds that we issued by a conduit, CCCFA, which is what we, CCA set up. And SVCE is one of the founding members of that. So that is the entity that will issue the bond. So Moody's will rate the rating of those bonds that's issued. And the credit rating that investors care about is not our credit rating so much. It's actually the funding recipient, the entity that's actually going to get the funding, which is not even CCCFA. Even though CCCFA issues the bonds, the proceeds, the way prepays work, will go to what we call a funding recipient. In the past, it was Morgan Stanley. I'll talk about some of the differences in this prepay versus our prior prepays. So it will carry the credit rating of that entity. It's Morgan Stanley, it will be Morgan Stanley, will be A-rated. If it's a lower rated firm like Deutsche Bank, their rating is not as good, it will be lower credit rating.
thank you.
And then how long is this credit rating valid? For example, you mentioned that if we defer the bond for say a year or so, is it still valid? We have to buy again the rating?
So the rating, so the way the prepays work, generally it's a 30-year transaction. But the bonds, because the way the economics work, we will do a shorter term, 5 to 10 year. Mike can correct me if I say anything he wants to say differently. But generally, and that's what we've done for the first 3 prepays, is we issue a shorter term, depending on the economics, where we can get the best savings. And then the bonds get refinanced. At that point, we can have a new funding recipient. So they will at least carry the ratings through the initial pricing period.
Yeah, and then Amrit, if I just may add, in the scenario where we wait, we think we're going to go to the market, so we get the rating, and now you're committed. If for some reason the market moves against us and we delay, it's usually good for 6 to 9 months before you have to reapproach. So it's not it's an investment that's still good well beyond when we first get it.
Okay.
Thank you.
Sorry, that was a question. Okay. Thanks, Mike. Okay, so the request also is we're going to have Morgan Stanley, who's going to be still underwriting the bonds. They're also going to be what we call the energy supplier. So if you remember the way prepays work, and I have more details slides in the appendix, is we take one of our existing power purchase agreements or a contract for energy. We basically take that and we kind of assign it to Morgan Stanley, the entity that's the energy, we call the energy supplier. And they take that energy and basically pass it to CCCFA, the bond conduit that we CCA set up, and then they pass it on to us. through that process, we capture basically, the savings basically comes from the funding recipient, which is usually a corporate entity, a taxable entity, where their cost of borrowing is a lot higher than a muni, us or CCCFA. And the savings basically comes from the differential between the muni rate and the corporate tax, corporate bond rate, what they can basically access the market at. So that savings then basically translates to us as like $1 per megawatt hour discount. So we pay basically the same power purchase. Let's say it was $50 we were paying, and last deal we got like $11 something. Let's say we got $10. Each deal is different. Let's say we got a $10 discount, so we would pay $40 a megawatt hour as opposed to $50 a megawatt hour. So that's how the prepay works. So in this structure, Morgan Stanley will be the one that will be underwriting the bonds, selling the bonds, and then one of their subsidiaries will be the energy supplier, where our PPAs get assigned to. They will continue to serve that function for this prepay. In the past, they've served what I would call 3 functions. Underwriting the bonds and handling all that, execution, energy supplier, as well as being the funding recipient. With this prepay, what we are setting up is called an SPV structure, special purpose vehicle setup, that we will basically get to shop a funding recipient rather than just go with Morgan Stanley, which will still be which they can still bid into it, but we can then pick whoever else we want. And the reason for that is, there's a few reasons. One, we can shop the savings, potential savings. When we initiate the transaction, we can see where we can get the bigger savings or better savings. And there's some trade-offs, right? So as I said, some entities are lower rated, credit rated. Generally, the savings from them would be technically higher because their cost of borrowing is higher, but then they may not have traction on the bond market, so there could be issues selling the bond, or they may bankrupt, our savings go away. And also, if we stick with Morgan Stanley, who we have done the first 3 prepays, there's a credit or concentration risk. If they were to go under, like in the financial crisis, like Lehman Brothers, we would lose all our savings. The way prepays work is we generally do not take any risk. If the prepay structure fails, we go back to business as usual. Our PPAs we assign comes back to us. We're obligated to pay the price we agreed to pay them, actual price, but we will lose the savings. So we do have, if one entity goes, do we want to really lose all our savings? Currently, our annual savings are like something like 14.3 million a year. So one consideration there is we may want to pick another funding recipient so we can diversify the concentration risk or credit risk with Morgan Stanley. These are some of the underwriting fees. Again, that we've listed here that we'll seek your approval for, and these have contingencies built into them. We expect it to be in par with what we've executed before, if not slightly better. And floating debt rate, we may not issue that. It depends on the time we go to the market, what the market appetite is for California debt. Okay, so very quickly, I've covered most of this already. The goal is to reduce our power purchase costs. As I said, we take the same PPA going through this so-called prepay structure, which, by the way, is codified in law. So before us, we along with AVA, we issued the first prepay through CCCFA in this space, clean energy space. But prepays have been around since 1990s. I can give you all the history, and they were predominantly for gas. Now CCCFA has become one of the dominant entities in the prepay and in the bond market now, issuing more than 18 billion or so of bonds.
This is similar to buying futures energy, is that?
No, it's sort of like a structured finance. So what we're basically doing is we're taking the difference between the muni debt rate and the corporate rate. And we're taking that savings and we basically capturing that to this prepay mechanism that's been set up and flowing through our power purchases that we've already committed to. I have diagrams if you want, I can go to them now or they're in the appendix.
When did we do the first three prepays and has it realized the savings that you were expecting?
Yes, so the first prepay, and a lot of these are in the appendix where we summarized, and I can definitely go through them if you want.
I just wanted to.
Because the first one we did was in, I believe, September 2021. That was the first one we did. At that time, the market, the differential between the two debt rates wasn't that great. So I think our savings was something like close to 1.9 million a year. The second one we did was in 2023, the month now, it's actually in the appendix. And the last one was January of 2024. Last one was the one we got the biggest savings, something like $11 or 30 cents a megawatt hour of savings, something like that. All in all three prepays, we get 14.3 million a year savings.
Who buys these bonds, Amrit?
So these are like institutional buyers like Vanguard, like I can probably give you more specific answer.
Yeah, it's large, accredited, sophisticated institutional investors. So it's not, it's nobody in the room buying these. It's Vanguard, it's BlackRock, it's all of the large mutual fund complexes that you can think of.
Thank you.
Sure.
Is it safe to assume that no one from the existing finance committee was here the last time we did the prepay?
I was,
Okay.
and I remember, it was my first meeting, and I remember being very confused that it was a really good deal. So I feel like I'm at a different level now, which is why I'm asking a lot of questions. So it's
Maybe the diagram one is the first
Exactly.
step. Would
Yeah, the
be
diagram.
Exactly.
Put it all on the same page.
Yeah, it's helpful.
Here's a simplified diagram.
Which slide is it on?
Oh, sorry. Keep forgetting. 21, can you go easily? Okay, so here's our famous diagram. So you can see these are the legs of the transaction. So we currently, SVCE, we have an energy with an energy supplier PPA that we assign into the prepay structure. So in this diagram, the PPA, the existing PPA that we have, let's say it's a solar with storage deal, they basically would take that energy and give it to Morgan Stanley. It's actually one of the entities, LLCs within Morgan Stanley. There are a few LLCs involved. I'm not getting in that level of detail. I'm just calling them Morgan Stanley. And Morgan Stanley also happens to be the funding recipient. So what happens, the second part is the CCCFA, California Clean.
Community choice financing.
I'm just used to calling it CCCFA. So this is a bond conduit that we were one of the founding members. It was us, MCE, AVA, and 3CE. We were the initial four that basically helped establish this. And their sole purpose is basically, as the name implies, be a bond conduit. So they generally don't have any assets. Is minimally run by CCA staff. And so they will issue the bonds. They will take the proceeds and then basically, this is where the word prepay comes from. They will basically prepay for that energy that comes from our PPA and give that money to, in this case, the funding recipient. This transaction is not necessarily Morgan Stanley, whoever the funding recipient happens to be. So they will basically get the funds that their treasury needs. So they'll, if it's $1 billion, they get $1 billion, right? So they now are recognizing the savings. They're getting the $1 billion issued at muni debt rate versus their corporate debt rates. So then at the time when this deal is structured, this is where Mike would come in, and as a financial advisor, he will basically look to see that are we extracting the right value between the two rates, make sure we get that differential that we then translate. So it's a fixed set of dollars, right? That we can compute. And Mike, along with the bankers, will go through all of their detailed calculations. That basically establishes the amount of money there is now. From that money, we will pay all these contracts that we talked about, the underwriting fee and all these consulting fees. And then then it's sized, and then we come up with the savings, and we know all the volumes that are assigned into the deal, into the 30-year structure. So all the cash flows are set at that point. Except the savings, as I said, is through the initial term of the deal, right? Let's say it's a 10-year bond where we refinance it or basically reprice it, reissue the bonds after 10 years. Then there will be a new set of savings at the 10-year, the reset period. So through initial period, we've determined basically for 10 years, let's say the reset period is 10 years, we know what the dollars are, the savings are. Then that savings, then the energy that we assigned to one of the entities of Morgan Stanley that flows to CCCFA, because all these are tons and tons of contracts that are involved in each stage. So there's an energy power supply contract, a prepaid supply contract between CCCFA and the energy supplier, in this case, one of the entities of Morgan Stanley. And then we execute into a energy supply contract with CCCFA, where that dollar megawatt hour discount we know for until the reset period. So let's say it was $11 for last deal. So we can give them energy. They will give us energy, and we will pay them the contract price less the discount. If we had a contract that initially we assigned into the deal, it would be a temporary short-term deal. It will be that price. Or if we don't, it could be an index deal. Settling against the California CAISO index price. And at the reset, it will be index price because we don't know what contract, because we can change these contracts. We can change the contracts at any time in the future too. So as we put in new contracts, you may say, well, you don't know the price of that. It will revert to an index price. The economics will work the same way. And the way the index price, then so that's basically the structure. And then there are some complexities around that. There are like commodity swaps that can take that index price and convert it into a fixed price so that the numbers work.
It's even more complicated by.
Yeah, but
It's
basically.
like the derivatives of the derivatives.
So yeah, this is what we'd call a structured finance deal. But the essence is basically the funding comes from the two debt rates. That funding is translated through this mechanism called prepay, which IRS, part of tax rules and totally proper and legitimate. That savings then gets translated into a discount for the energy that we would have bought anyway.
So all of this is not dependent on market conditions?
It's dependent on the market conditions at the time we issue execute the deal.
So you're locking in the savings, you're locking in the rates?
At the time,
At the time.
basically it's the debt market, right? When we did our first deal, at that time the market wasn't that good, but years leading up to that, to the COVID period, there wasn't much of a savings. And then the market opened and we captured it. And then up until early this year, the savings were really, really good. The spread between the two rates. Right now, there's a lot of uncertainty. Liberation Day and everything that's playing out in the markets. And I'll give Mike a chance to give you an update on the market. So we will basically go when we think there's good savings and we can capture it, and we'll look to Mike, and the bankers will also inform us. That's when we will execute. Mike, do you want to give a brief update on the market?
Sure. It's largely been bad news the last few months, so I apologize for that. But yeah, I think it's been particularly volatile over the last few months since Liberation Day. I think the market was very surprised at the reaction to the tariff policy and the changes seemingly every day or week, with those policies. Um, so that sort of created a challenge for these transactions at the present time. But prior to that, to start the year, there were, 3 or 4 of these transactions that were done in California that received, really, really favorable results. That relationship between taxable rates and tax exempt rates were at a good spot. I think, as things sort of calm down, as the amount of negotiations come to a conclusion on the tower front, I think the markets are starting to revert back to a position where we can start to do these transactions again. So, I think you're putting yourself in a good spot by starting today. And I think our hope is that within 2 to 3 months, the market will be at a stable footing so that we can execute and be in a position to, achieve the type of savings that you've gotten before, if not better. But it's been a little bit of a rocky ride if you've been following it yourself with your own personal activities. So we're hoping that though is now coming to a conclusion.
And you're talking about you're talking about, when you talk about volatility in markets now, it's like everywhere, right? It's the bond market, it's the stock market. Right, but the volatility you're concerned with is the bond market volatility.
Bond markets, yes, very much so. And stock markets and bond markets are somewhat historically correlated, but there's so much going on that's not always the case. And what we've seen is a rise or fall of interest rates as much as 1/4 of a percentage point in a given day. Which has not been something that's happened very frequently in the past and historically. That is not so much what we're concerned about. It's really just that relationship. Rates can go up, and actually when rates do go up, it's kind of better for you because there's more opportunity for a difference between that taxable rate and the tax exempt rate. So it's really just that relationship, and that relationship goes up and down as markets go up and down. So it's more of, it's not so much rates go up or rates go down that's the problem. It's more of just, there's no opportunity to save money if the taxable rate and the tax exempt rate are the same rate. We just need we need the taxable rate to be at an appropriate spread higher. About 1% higher is approximately where we need it to be.
Thank you.
Sure.
Okay, so we'll go back to slide 6. So basically, with slide 6, so as I said, the first prepay took us 2 years to structure, right? Because that was new to us and everyone at the CCAs. Now we get to leverage a lot of that language and contracts that have been put in place. And the other points here I've kind of made already. Since our initial deal, there's been a number of deals. So this is kind of a mainstay in our business now. And as I said, CCCFA has become one of the largest noticeable bond issuers in the country. Okay, so for this prepay, we did an RFP. So basically, we sought out other financial advisor in addition to Mike's firm, as well as other energy suppliers. As I said, with the financial advisor, this is required. We have to have one, and expertise in this area. We've worked with Mike on the 3 prior deals very successfully, and we'll do that for this 4th deal as well. On the energy supplier side, we issued an RFP. We had 4 entities that basically submitted. They were all good, and 2 of them were very competitive, Goldman and Morgan Stanley, and we both very good. The reason we went with Morgan Stanley in large part is, we get to leverage a lot of the deals we have done in our existing prepaid deals by pooling all our resources together, because it allows us to more efficiently manage across prepays in the way we assign PPAs. So, and that structure that we set up with Morgan Stanley, I'm sure Goldman can do it, but they have not done it to date. But even if they were to do it, which absolutely they can do it, they would be in a different pool. It makes sense. It's easier to pool resources when they're all in one pool. Otherwise, we lose efficiencies. We will not be able to utilize all our prepays to get as much savings. We will end up, because with the way prepays, you have to assign the energy, remember? And we have to assign them at a certain level of confidence, like 90-95% confidence level, because these are intermittent resources. And then also we have to take pieces from one another and fit them in. And when you try to shape that, you have 2 different pools, there's a lot of inefficiencies. There will be some megawatt hours we won't be able to assign into a prepay. So it helps to have that one pool. The risk with Morgan Stanley, as I said, is if they were to become Lehman, we use it, but the failure of the funding recipient is more critical than the energy supplier or the initial stuff that they do to underwrite and issue and sell the bonds. And the funding recipient, as I said, we don't have to take Morgan Stanley. The choice, they can submit, they're attractive, and we care about the credit risk, we could, but if we do, and diversify and go with another funding recipient.
Good question. So was a concern about concentration brought up at the 3rd prepay, or is it now that we're at the 4th, it's kind of, I assume this is always a risk, and so you're trying to weigh the risk of if one entity goes under versus the efficiencies. So when does it feel, like, did it feel this way at the 2nd prepay or the 3rd prepay?
So we've committed up to 40% of the volumes of the first 3 prepays. And remember, these prepays will open up. This first one, I think, was, I forget the term, 8 years or something like that. Second one is shorter, like 6 years.
Okay, and the second one was 2023.
Yeah. So these will open up and we're going to work through Morgan Stanley to change them to this structure where we can, we're going to try to work with them to change it to this structure where we can select other funding recipients so we can select them. Yes, so adding them now, having 40% committed and now committing 50 to 55% with the same, it is a concern. And also the dynamics were a bit different. When we did our first, we were the first ones out there, right? And now there's been so many prepaid deals done through CCCFA. And so it was an opportune time to revisit it, whereas the first prepay took us 2 years working through that. And we wanted to quickly go to the market when the markets where rates were getting attractive and issue the second and third one, which kind of did immediately. So the credit risk is always there. We're trying to minimize it, but we want to be mindful of that now. Again, we don't take any additional risk through prepays. We do risk our savings. And if they were to go under, we could then do another prepay.
Okay.
But it's, so it's not like a huge risk, but nevertheless, it's part of the mix. We want to think through that concentration risk.
So are there any lessons learned from the first 3 prepays that make us change the direction we're going in with this?
Yeah, the big one is actually we've implemented with Morgan Stanley. others will be doing is the settlement used to happen on a monthly basis. And so what happens is basically when we assign a PPA into the structure, there's at certain conference, like 95% conference level, we assign the volumes and we say, but these are intermittent resources, right? So the generation varies, it's fluctuations. Sometimes we could under-deliver, sometimes we could over-deliver. We have to make up the shortfall if we under-deliver. So through this process that's been laid out, all these are complicated processes. And because we have to target to hit that monthly volume with certainty, we have to assign more PPAs, hit that certainty, or more volumes to hit that certainty, right? Which means less volumes available for another prepay. We have worked now to change that instead of settling on a monthly basis, setting on an annual basis. So on an annual basis, make sure you hit the target as opposed to monthly basis, which means now more of a certainty of hitting annual versus each month, right? So that means I use less PPAs or less volumes. So now I have more volumes I can dedicate to another prepay and get more savings. So the same level of savings, I'm using less megawatt hours. So my essential realized savings on megawatt hour basis is larger. So that's one improvement.
What is the bond value of fourth payment, first payment, second, like that, or is that based on the energy consumption?
So basically we come up with a pot of dollars, right? So say we do $1 billion, and then all the costs get netted out, and the dollars, basically there's a schedule that's laid out. Principal interest due every 6 months. So that schedule is laid out for the term of the transaction, and that's how that works.
Okay, so $1 billion, you all the.
It's a coupon.
Coupons and.
And principal gets paid every 6 months.
So this is the fourth prepay. How many we can do? It depends on the energy consumption, right?
Yeah, so that's what I said. I can't do 100% because of this. Against this, we have to get it at 95% confidence level, right? So we go to intermittent resources. So that with this enhancements now we're opening up the volume. This will take us to 55%.
Okay.
And we can probably go more.
Okay.
I don't think we're there yet, but each one we do, we have to, we have to do this assessment. Can we manage our portfolio to hit those volumes? That's why some of these refinements, enhancements that Sheila asked is very important. So that's been one enhancement. And the SPV is where we can shop the funding recipient, even though this has been around. Goldman had the structure before Morgan. It's also, I say, is an improvement for us now that we don't want to be concentrated with Morgan Stanley. We want to shop around other funding recipients who make potentially better savings.
And I would also assume that it depends on the market condition. If the interest rate comes down, the savings will reduce, right?
Yeah, again, as Mike said, it's the spread between the two, taxable and taxes. If that spread narrows, there's no savings. Spread wide.
That is what happened in 2021, looks like.
Yeah, the spread opened, whereas before it was kind of out there. We captured it, but it bounces up and down, and no one can time the market. By the time we did our last prepay, that was the best for us. And the CCA that did a prepay this year, early this year, I think they got one of the larger savings, one of the best savings. And then all this turmoil happened in the markets, and yeah. So those are some of the investments, and I'm sure we'll learn more and continue to improve them. And as I said, these initial prepays we've done, at least we can reprice them, the repricing periods. Okay. So these are the contracts specifically that we're asking for. And there's some contingency built into overall cost, I think. Maybe not in these, sorry. So this is specifically the fees. Again, these are all contingent except for Moody's, and Moody's is an estimated fee. And if the deal doesn't go through, except with the exception of Moody's, we are not obligated to pay these. Moody's, we will only initiate once we have over certainty that we can execute it. And we also got verbal agreement from Morgan Stanley that should the transaction fail, they will split this fee with us. And we had that in writing for the first three, and I'm sure we're gonna get it in writing for this one. They've already agreed to that.
Okay, why would they do that? I mean, is it part of their responsibility to help this go through, or?
I think we asked and they agreed to, Mike, we have the.
Yeah, I think they're willing to split the risk with you. I think they're usually pretty confident, as we've noted, Moody's is kind of the last step before you go to the market. So we're going to wait until we have really high degree of certainty at that point. So I think Morgan Stanley's comfortable bearing that risk. And I think a lot of this being contingent, I think the proposition was, you're not taking a lot of risk here. So they understand that and they're willing to cover half of it.
Okay, thank you.
Okay, the next slide. Show you a little bit about the volumes. So the first prepays covers about 40% of our load. With this one, we could be anywhere between 50 to 55%. Depending on when we go to the market, we'll be able to get a good feel for the size of the transaction. And the savings, again, will depend the spread between the tax and tax exempt debt at the time we go to the market. I've given you some examples of our previous savings, and they're also in the appendix. Anywhere between 8 to 10% or 4 to 6 million. Would not be unreasonable to think we could get this. The rest I've covered. The fees again are contingent on the execution. The bonds are non-recourse. So in other words, the bondholders cannot come to us. It also doesn't show up in our balance sheet. Non-recourse to CCCFA as well. We do have a footnote disclosure in our financials, but it's not our debt essentially. So with that, I can take any other questions you have. I think so recommended for approval. I think I have 2 slides on that, so I'm getting confused. That we request that you recommend the board. Oh, this is next step. Sorry, I'm reading. Normally I get a chance to preview my slides. It's been a while since I looked at them. I didn't get a chance. So the next steps is we're going to go to the June board. We're going to share the same details at the board meeting. We're going to work with the Morgan Stanley and the parties to structure some of the transactional documents. All of that we will bring back to this committee in August. So in July, we don't have any board or committee meetings, so we're off month. So we will come back in August, early August, to meet before the second Wednesday. At that time, we will come back with the size of the deal and all the associated contracts that go with it. And then we'll take it to the board for approval in August. After the board approves, then we have to take the CCCFA board approval, and then which is later in August. Assuming we can stick to this timeline, but that's our expected timeline right now. And the issuance, even though we said Q3 to Q4, it really depends on the market. Once we have CCCFA approval, market is there, savings look good, we can act on it. If not, we can, as Mike said, we can wait. We initiate that transaction.
So what's the best case scenario for timelines?
I think we're assuming we can be ready by late August after the CCCFA approval. If the market opens up before that, for CCCFA, we'll see if we can. We won't be in position until our board meeting, but chances are we have to wait until at the earliest late August.
And then the whole process takes several months, right? Because you said the first prepay was 2 years.
2 is getting to this point. Getting all the contracts, structure, everything all aligned. The execution can happen fairly quickly. Once they get an indication the market is there, I think we can close the deal within a day or so, and then it takes a week to finalize everything. So close and
Yeah, I have one more question from when I was reading yesterday. I think you kind of touched on it, but does the SPV structure this time do anything to lower our risk on previous prepays?
Yeah, so one way it lowers our risk is we're not locked into Morgan Stanley. We don't have to go with Morgan Stanley. We can go with anyone else, right? So this is a concentration issue. If Morgan were to become Lehman of the financial crisis and all prepaid savings were to go away, we can diversify that risk. We can go with another funding recipient. So that's how it kind of lowers our credit risk. And then, of course, the funding, initially when we'll get indicative bids from a number of interested parties, not just banks, not just one entity, Morgan Stanley. I think past CCAs have gotten deals from insurance companies. Also, if we see, that, so we can also shop where we can likely get the better savings as well.
So there's sort of an efficiency of having everybody in the same system that should pay off, but might be difficult to quantify. Which is okay.
Yeah, quantification will depend again on market, and different people will be able to give you a different savings rate because their rate, they are comparing their taxable rate to the tax exempt rate, and that could be different for a number of reasons, right? Each entity is different. They have different credit ratings, drive the savings, credit risk. So the savings will be driven by that, and then we have our decision to make. Funding. Let's say Morgan came back and was the best, gave us the best indicative rate for savings. At that point, we're like, should we go with this or should we go with the second highest, because now we want to diversify from concentration risk. So that would be a decision we would have to make in the future.
Okay, thank you.
One question I had, what happens to the bond market if all the CCAs are doing similar thing?
We had this issue where we had a number of prepays going just about at the same time, and we were working through CCCFA. Monica is actually on the board of CCCFA as how we should handle it. But actually, the appetite for California debt was such that never became an issue. All the prepays were be able to successfully execute. Mike, do you have anything you want to add or?
No, I agree with that. I think there's a tremendous amount of demand for these bonds. They're green bonds, so I think investors really like that. It's very attractive, in particular in California because of our, we're triple taxed. We're very blessed. We have very high taxes, so there's a tremendous amount of demand for tax exempt debt. And even when there's been a number of active CCAs at the same time, the market's been able to digest that, and folks have gotten really good savings. So.
We know, at this point, we know there's MCE is going to market, is ready to go to market. They've got
Like one
approval,
point
right?
four billion.
Yeah, so they got CCC FA approval meeting. So they're out there, they could go to market, possibly before us.
Any other question?
Not, I do believe next slide is, oops.
That was the recommendation.
I haven't changed there, but I haven't changed here, yeah. It's the committed slide.
Okay. We'll open for public comment. Anybody from public wishing to speak on this item?
No hands raised for this item, Chair.
Okay, we close public comment. Any last minute comment, if not motion? Would like,
Yeah. Move approval?
okay,
Second.
do we have voice vote or?
Oh, yeah, you can do a voice vote, and just to confirm, this is to recommend that the board authorize the CEO to approve or execute contracts for services for SVCE's fourth prepay transaction, and also recommend that the board approve engagement with Morgan Stanley as the prepay supplier.
That's correct.
Okay, voice vote, say aye.
Aye.
Any abstain? Okay, thank you, that carries.
Okay, thank you.
Thanks, Mike. Thanks for, see you at the board meeting.
Thank you. Yeah, good morning. Bye.
Next is stress test results
Okay.
analysis.
It's a big, long item.
Yeah. So you're presenting, right?
Yeah. Unfortunately, I can't get it.
Water or something? Okay, what you?
Yeah. Well, I do appreciate you walking us through this, reading it on your own.
Absolutely.
quite
It's
I don't have a lot of
complicated
context for
It's
this.
complicated, but then it's, oh, you mean the stress test? Or the?
Just all of these reports, yeah. Yeah. This is,
stuff. It bounces off.
I've learned a lot serving on this committee. I feel like only enough to be dangerous, but I've learned.
yeah, aim to be dangerous.
That's-
Okay, so not to stress us out, but this is this management exercise we do. The past few years.
Yeah.
So there's a lot of material on these slides, and a lot of them were in detail in small fonts. They were meant so that hopefully if you were just reading the slides before, they could stand on their own. That was the attempt.
Yeah.
But at the presentation, go through slowly and you don't feel like you need to read anything on these slides. So I will go through the findings of the stress test analysis. I'll briefly review what they are, how they fit in our overall planning and budgeting process. And then we'll go through the 5-year financial forecast. Joining me is Scott, our Director of Risk Management, who led the analysis. And then I'll talk about the stress test construction. And then I'll compare the base case, the new, not the stress case, but the new updated base case at the time we did with the same assumptions, same market period as when we did the stress test. What that base case was, and we'll compare it to the mid-year budget, that was the last 5-year projections that we shared with the committee. And then I'm going to recap some of the messages that I'm going to be building up, leading to why we're recommending what we're recommending. And hopefully, if I've done a good job, I will be building up to those recommendations. Okay, so first part is we're going to review the enterprise risk management framework and the key drivers of the financial risk. So remember, this is something we shared with you guys in detail at the February meeting. And this is when we proposed the financial stress test, which we have done just about every year because this is it continues to be the major financial risk we're facing. That's why we continued with that with the updated data. A little bit about our planning framework. Thank you. Can do both. So we start with the bottoms up risk management framework, just because stress test is a component of that, but in the bottoms up approach, we basically engage everyone in staff, look at all risks, not just what we're talking about today. And then some of them rise to the level of strategic focus areas, and that doesn't mean we don't handle all the other risks and all the other areas. It's always a continuous process. We may not formally go through the updating of our risk register process, but through our internal discussions, very much we go through that process. And then leading to how we want to manage the organization drives basically how we set the budget and the directives in the budget. So very quickly, key components that we had gone through last time. There's a risk register, which is a record of our risks and opportunities. And these we measure basically against our business objective, right? Our mission. What can move the needle? What opportunities are there that if we were to act on them, we can move the needle on achieving our mission? Or what risks are there that can derail us? And then that we want to be sure that we have good mitigations. Because we can't obviously mitigate everything, and we can't always prioritize everything. So it's always, not everything is as important. So that's where this framework comes in. And then there's sort of a rubric that we use, which is basically we do an assessment of, when we talk about risk, there's two dimensions, at least in assessing them, which is how likely are they? So remote is not going to happen, or is it going to happen very frequently, and then what's the impact? Even though it may happen very infrequently, but if it happens, it wipes us out. It's a risk we want to address. Or if it happens, it's not likely to happen. If it does happen, it doesn't cause major disruption. We can probably take that risk or do some moderate level of mitigation, right? So, and then the stress test is a component of that. Here we basically, even though we have standard risk management measures and metrics that we monitor on a weekly basis, on a formal basis, because that's how important some of these risk drivers are, especially related to the commodity markets that we deal with. We monitor them at least on a weekly basis. But those monitoring is not going to capture sort of the black swans. They're not going to predict the financial crisis or the commodity crisis or the utility going bankrupt or a major legislation or regulation disrupting us, right? Those things are just inherently not captured in those models.
Okay, so that's the thing that I think we're all worried about. So really, it doesn't capture, for instance, if federal subsidies to the projects that we've invested in go kaput, and those projects, will those projects no longer be viable? I mean, that isn't really part of this, right?
So that's a separate risk. It is part of our risk framework because it affects our mission.
Yeah.
And that's actually in our risk register, the IRA plus the directions for new administration that better monitors for us on a
Daily basis now,
daily
yeah.
basis, yes. if not more often than that. So we measure that and we take actions like, through CalCCA, like Monica's got a special board meeting coming up on CalCCA for something that's materializing. So that goes on. Yeah. Here I'm talking about the financial risk, that these are more that will affect our bottom line of our ability to basically stay competitive and be in a healthy financial situation. And those, for the most part, as I will show in the upcoming slides, are driven by market prices, price for energy.
And those are really, for the most part, state, right?
There's a market.
Where the
The
market,
state
but
has an
most,
impact.
but most of our market is within the state. We're not very far from it. I mean, it's within the western states, right?
Right, I think when the risk that you're talking about in terms of the production or the investment tax credit going away, or tariffs making the cost to build renewables
Yeah.
more expensive, or even delaying or potentially canceling some projects, that we factor in as how we project it's gonna cost to meet our 100% clean goals.
Okay.
So that becomes part of our planning. So we have already incorporated much of that into what we think it's gonna cost us to meet 100%. So those aren't really like these stress tests, like what Amr is trying to talk about today is like a big thing happens in the market and it changes fundamentally how we either receive revenues from our customers or something fundamentally changes how our costs as well, big time. We're already planning for those events, the ones that you're talking about.
Okay, well, I think we're all really concerned about that, and
Yeah, those are part of our risk framework.
how it
as Monica said.
intersects. Thank you for
But
sharing.
here, yeah, but when we did our assessment, again, we looked at likelihood and impact. This one is a huge financial impact. And in stress tests, we can also do stress tests related to other items such as that. But when we looked at which one we should do and prioritize, this one was continued to be the big one. And there's another risk that on the legal front, some of you may have heard that we're working on that I can't discuss because of non-act rules of closed session. We're also working on that with Mike.
I think Scott has his hand.
I just wanted to, since we paused to touch on this, I think there might be something in the presentation later, but we did assess whether the loss of not yet online PPAs would adversely affect us on the financial side, to Amrit's point about focusing on the financial stress, and also assess what it would do to us from a compliance perspective. And we did not specifically include it because when we pulled, I think, I forget the exact assets, but we pulled 4 PPAs out of the portfolio and did review it. The cost or the price on the PPAs was relatively close to the market replacement cost. So it didn't create a significant financial burden on the portfolio. And removing those assets from the portfolio did not force us into a compliance violation of some kind that would create fines or penalties. So again, we looked at that both ways. The portfolio is in a good position to be resilient, even if we lose, I forget which 4, but 4 of the what we called potentially at-risk PPAs. So something we considered, not for the reason you mentioned, Director Shoulder, not because of the federal rules, but if those rules did cause those to go out of viability financially for the developers, and they tried to get other contracts and so forth, we did look at what the impact would be for us. And that doesn't get to Monica's point, which is in the long run, what does that do to the cost of ongoing procurement? So.
Thank you, because I mean, I'm sorry to interrupt, but I think that all of us, we get questions from our constituents about this, and to understand how it's being, factored in, so we can explain it in a coherent way. It's really important, even just that there, yeah. So thank you.
I think the main thing is that costs are gonna go up.
Yeah.
And that's what we're planning on in terms of meeting our 100% clean goals. The cost of the next renewable resources are likely gonna be more expensive than the ones that we paid for in the past.
Yeah.
Because it just, these credits really make a difference. They make a huge difference in being able to fund and make these projects viable. So if the credits go away, or if there's a lot of uncertainty around the credits as there are right now, or confusion about what they do and don't do, then that just means that the developer has to factor in a higher price when they're selling their resources, and then the consumers have to pay for it.
Okay, so in the next slide, on slide 6, I'm gonna review why we modeled what we modeled. And as the slide says, the biggest contributor to our financial risk financial viability for that matter. It risk actually comes from the revenue side. Also power supply side, but because that's our biggest cost. But they're related, as I will explain to you. So the biggest contributor to the revenue risk is PCIA. Remember what PCIA is? This is what our customers pay PG&E for the commitment they made on their behalf in the past. And of course, what PG&E charges, right? So the diagram on the left illustrates this concept. Our revenues is basically that blue box times the sales volume load. So what rate we charge times our load, volume, rate times price times quantity, right? And what affects the blue box is the PCIA. PCIA shrinks, I can move that blue box higher. If the PCIA goes bigger, remain competitive, I have to shrink the blue box at the rate I charge the customers, and therefore the revenues I get. So the PCIA matters, and what our competitor PG&E is charging at, right? Because we have a large amount of price sensitive customers. We have a lot of something like 2/3 of our load comes from commercial and industrial customers, and they're very sensitive to price. So we try to remain competitive, and those are the two big contributors. So as the diagram on the right shows, that PCIA goes up, revenues goes down. PG&E rate goes down, revenues go down. So that's where our risk is. We're looking at the risk side. And you might say, well, if these things go down, maybe I'm jumping ahead a little. Shouldn't our power, because what drives PCIA and PG&E generate is basically the price of energy. If they go down, shouldn't our energy supply cost down? It does go down, but it doesn't go down as much because we've hedged. And we are accounting for that dynamic a little bit in adjusting the way we hedge. And I'll touch on that a little bit later as well.
There's nothing that shows that PG&E rates are going down.
Yeah. Okay. So there's a couple of things. PG&E's, think of their rates as two big components, or three components. One is the generation, which is the service we provide to our customers. There's the wires and transmission and distribution, the wires portion. A bunch of other little things like subsidies and state funding and all that stuff. But T&D is what's going up like that. Commodity generation piece basically depends on these market prices and their portfolio. Their portfolio is hedged or not hedged, and how the market moves. So that's the part we're comparing it. Their rates on T&D have more than doubled, as we showed in last 5 to 10 years, right? That T&D portion, because of wildfire mitigation and the undergrounding and all sorts of things that they're doing. It's just, used to be, I think when I came here, it used to be 50-50. Now the non-gen piece is like 67. Yeah, 2/3 of the bill is the T&D.
Our customers pay that too, so.
Yeah. So that's why the bills are going up, but our revenues may go down because of the gen rate.
I have a question. Besides hedging, PG&E doesn't have to be as clean, right? So if all of a sudden they have lower prices for energy sources we wouldn't use, that would drive the price down.
Not in the short term. In the short term, they don't have an obligation like we do to be 100% clean. That's a board directive. That's our internal policy. But long term, all of us, all the load serving entities in California have to get to 100% clean. So long term, they will be buying or keeping their clean energy to themselves. Yeah, and then the other thing that we keep talking about a lot is that midterm reliability procurement order. We talk about it at the board quite often when we sign long-term PPAs. Part of it is to meet that obligation. PG&E has that obligation as well. So they have to sign new contracts and build new resources. Those will come on starting in 2028 for them, and then we'll start to see the cost of those within their generation rates as well.
And they're fairly clean. It's not that they're
Yeah, they're clean.
They don't have as high a RPS target as we've internally set, right?
Yeah, and the 100% clean target.
How long-term is long-term for them?
Um,
20, 40 or something?
minimum 10 years, but some of their contracts, they tend to sign really long-term
Oh,
contracts.
same as us, 20 years. Same, these are industry standard terms. What do you
But
call
then
it?
doesn't California have 2040 or 2045?
2045, 100% clean.
100%.
Yeah, but BG&E has a very large portfolio of hydro resources,
Okay.
which are not RPS, which they can count towards their requirements.
It's also ours.
Yeah, we pay for it in the PCIA.
Yeah, we could-
So topic for, we'll touch on maybe. So a little bit about building up my story here. I may run out of time, so I will have to speed up probably.
Yep.
Yeah, I know, we are running out.
So big contributor is PCIA, PG&E generation rate, and the uncertainty in the market prices is a big contributor to PCIA and PG&E gen rate. So and the main point I want to make in this slide is if I look at 1 year, like this year is going to be a very good year for us, this fiscal year ending September 30th. And we'll talk about later why that's the case. When PG&E sets the rates for, let's say, 2025, they basically look at, what the forecast, sort of like what a forecast rate is for 2025 back in 2024 when they set the rate. The rates, the market prices are not known, right? And they use that to set their rates. They use that forecast to set their PCIA. The way the PCIA works, it is actually supposed to be very trued up the actual market prices. And the reason I say sort of is because for energy, it does 100%, right? Because energy is a financial clearinghouse in the California ISO market. All resources clear. You look at that transparent price, and they will basically look at, well, what did I forecast at? What was the CPUC authorized forecast rate for that? What did it settle? And they will keep that into a balancing account. So if they, let's say this year they undercollect, right? Because the prices were set high and market prices came down, which is the case. So there's that balance sitting that basically next year we will have to give back through higher PCIA. Same can happen on the gen rate. If the customers are paying based on a high commodity price forecast, PG&E will have to give that back to their bundle customer, bringing their generation rate down. So you cannot look at 1 year and say, I can bank that. Because what we're making today, I could, in the form of higher PCIA and more PG&E gen rate, I could be giving that back next year. So 2 year, that's why I highlight greater focus on next 2 years. The way we do our planning, we look at 5 year, put greater focus on 2 years for that reason. And so that's the message I want you to take from that slide. Okay, so now I'll talk a little bit about the base case. We made a projection in mid-year, if you remember in mid-year, based on the projection, we did show declining margins. We did show next year was going to be negative, but not as negative in the latter years as we're projecting now. So I want to bring you, big, as I said, the big uncertainty is prices. See, those prices are the reasons our projections have changed. Now we're going to project even more negative. We're projecting at mid-year for the 5 year periods. We'll talk about those uncertainties. So very quickly, this compares the reserve outlook is how I'm showing you the impact. This shows the reserve outlook in orange, or close to orange, is the updated base case. In the blue is what we were showing at mid-year, which at that time, the forecast went through the end of fiscal year 29. And now we're planning for next year, so we're adding one more fiscal year in our planning horizon. That's going to fiscal year 30, fiscal year 29, 30. Short, I'm just gonna say fiscal year 30. Okay, you can see that our reserves are coming down quite a bit, especially in the latter, towards the end of the projection period. For the next fiscal year, there is an impact, but not as much as in 2027, and that's because of the delayed impact, the 2-year impact. And remember when I said energy prices, we settle almost perfectly because of the California market. There are 2 products called RPS and RA. There's no such markets. So the CPUC comes up with a methodology, which is somewhat backward looking. And I'll go more into that as well. And that methodology sort of delays some of the impact into 2027 also. So there's that impact. And the other thing I want to emphasize here is when we do these projections, how do we come up with assumptions for prices? We just make these numbers up and pull them out. For the base case, we try to follow the industry standard practice, which is attempt to mark to market. So imagine your portfolio, your investment portfolio. You open up your brokerage account, it gives you how much is it, plus or minus gains for the day, year, and so on, right? Basically looks at the current stock price or investment, whatever is in your portfolio, and basically what you bought it at and sort of mark to market, right? That's the mark to market concept. Same in energy. At current prices, what our portfolio is, that's that, and we calibrate to the current market prices for future years. So there's a different concept there. I'll come back to that. And then the same prices we use for the PCIA and PG generate projections. And some uncertainties around that too, which I'll talk about. But we use those prices, and those for energy, that price we basically observe in the market. Energy is more. There's more volume, more transparency, because it's traded more. The RPS and RA is very thinly traded. That adds to the risk because there's not as much price discovery. But we basically look at energy, for example, that's trading 5 years from now for delivery in the CAISO market, what people today are willing to transact at. That will change over time. It changes. When I did this forecast, it changes today to tomorrow and hour to hour. It's basically what people are trading at. Just like your stock price changes throughout the day. This is, you can think of the energy delivered in a future period as a different stock, and the energy delivered today or next month as a different stock. And there's correlations and all that. All of that modeling we do, standard modeling. Okay, so you can see a 5-year projection has come down from what we were projecting at the mid-year. And this is getting at the point I was making at market price change. So again, we're using forward prices. First, whether I'm talking about energy or any product, there's more price discovery and there's less uncertainty. Or there's still uncertainty, but less uncertainties for something, let's say, that's going to be delivered next month. But the range at which it can go up or down, there's less. Further out in time, there's huge distribution around that price, right? So there's more uncertainty further out in time. So that's one important concept to remember when we show a projection next year versus 5 years out. That uncertainty translates into the financial projections we're showing you as well. There's nothing we can do that we live with that uncertainty. It's our risk in our business that we have to manage. But there's that uncertainty. Then there's these illiquid products called RPS and RA. They have less of a price discovery than energy because they're thinly traded. So even next month's price, there's more uncertainty for these products than, let's say, for the energy because of the trading, and then also the way that CPUC handles them. because there's no transparent market price that they can use. They use this averaging impact where they look at past number of months leading up to a settlement date to basically determine what we settle against on PCIA. And does uncertainty always, so uncertainty, there's two sides to it, right? Think of a distribution of prices. There's a right side, prices go up. So the way that our portfolio, energy portfolio, and the way our rate setting is right now actually helps us, right? Prices go up. In terms of financial projections, they help us. Prices go down because of the higher PCIA and lower gen rate, PG&E's rates hurts us. So there's a right side of the distribution and a left side. When we're talking about the risk, we're talking about the left side, prices coming down. Equally, prices can go, there's a chance prices can go up. And has that happened? Yes, you can look at RPS. You know, as I said, you can see in a short amount of time how much these prices have changed. You know, and these are reflective of what the markets were trading at for full delivery for RPS delivery in 2025 and RPS delivery in RA resource adequacy delivery in 2025. You can see how quickly they have dipped. When we did the mid-year forecast, the price snapshot of prices we took was towards the end of January. So you can see a sharp decline between then and April 18, which is a snapshot of prices we took to develop this forecast. This final forecast is basically that CPUC methodology for these products, determining the price we settle against for PCIA. Okay, so a lot of concepts, but what I want you to remember is a lot of uncertainty out there in prices. Certainty is greater in time than nearer in time. And when you read our financial projections, you should have that understanding that those uncertainties translate into the projections we put out there. Okay, in the next slide, we basically are showing, you know, that actually the uncertainty in the last couple of years worked in our favor. Again, there's right side of the distribution, the left side, right? Prices can go up and it can help us. And you can see the last 2 years, and we talked about this during the budget setting time, you can see the energy price, the CAISO price in the blue line has actually dipped for 23, 24. When we were going through this budget years, we said, we're going to be facing some tough years. But then we also said there's great uncertainty because RA and RPS prices that I showed you in previous slide, you can see they skyrocketed in the same time period. The dynamics driving around the RA and RPS market at that time. If you remember, we talked somewhat about at the board meeting and in budget planning, which was we were having difficulty meeting our clean positions because of huge market demand for these products. And there was also a compliance period that people had to comply with at the end of 2024. So they needed a lot of those resources, RPS resources. So you can see, because RA and RPS prices went up, you know, our net positions did very well. We did very well. They also show you the correlation in the prior years. You can see prices going up and our projections have gone up, with the exception of 2021. We had a negative year. And you can see the price trend there increase was much less, and there was lots going on in the way PCIA was handled at that time. So now very briefly on some of the other uncertainties baked into our modeling. For prices we talked about, right? Then how do we compute future PCIA and PG&E generation rates? Is modeling uncertainty. It's another huge layer of uncertainty. PCIA, we should know what's in it because we're paying for that. PG&E will not share that data with us. We have to guess, we should not have to guess. They are like positions in our portfolio in essence. We have to bear the full financial risk of it, but yet we don't know how to, we cannot model it in our portfolio. One of the issues we're debating at the PCIA proceeding going on in the commission, that they reopened that proceeding. So that's a black box. And even more black box is the PG&E generation portfolio. So we use whatever public information that the CalCCA consultant models into the model called New Gen model. And if you look at the way we set our budget, we moved major rate making decisions from September to December, where we said by the time we go to December, there's more certainty knowing what the rates will be. Again, we don't know 100%, but we have far more information because of CPUC's prices used to compute set rates will come out in mid-October. Last year, they changed it 3 times. We came into late November and made some of us all very, very long hours and late, close to the committee meetings. So there's that uncertainty. And then there's regulatory uncertainty. Last year at this time, PG&E basically said, hey, Commission, they saw this trajectory of prices, RPS and RA said, Commission, don't use those prices, just use last year's lower prices. And all of that is going on in the PCIA proceeding right now. So all these uncertainties are there that's baked into our financial projections.
And the CPUC decides in fall, is that what you said?
CPUC sets the market price benchmark for this RA, RPS, and even energy that's used for setting the initial rates for 2026. That those rates come out in October, supposed to come out in October.
October, okay.
Around October 15th. And then they set the final rates actually towards the end of December, basically in January is when we know. But based on those numbers that come out, we thoroughly know what the rates will be. We have a much better projection than right now.
One of the things you said in the past is you wait for the PG&E or the CPUC to make the decision before you set your discount.
That's exactly what I was talking about. Yeah, so that's that market price benchmark that comes out in October. That's a key determinant. Again, we don't know the final rates because PG&E still does a minor true up from that projection to November. In December, they filed the advice letter. Late December, what the rates will be that the CPUC then approves, which then become effective January 1. So generally, we don't know the rates technically until January 1. But based on that important benchmark that comes up, price comes out, and the update that PG&E does in October of their ERA forecast, which they do one initial forecast right now. They'll do the update once the CPUC's energy division issues those prices. 15, they'll do. Based on those updates, we have a very good indication of what the rates will be. That's why we moved our major decision makings on our budget to rate setting to December or September. So imagine in 1 year how much uncertainty there is. Think about a 5-year forecast. That's another thing you should take away from that. And the other thing is, as I briefly touched on, is the PCIA. As mentioned last year, PG&E came and said, hey, Commission, hold off because this RPS, RA prices are illiquid. CPUC basically opened up the whole proceeding. Now they've broken it down to 2 tracks, track 1, track 2. Track 1, which is supposed to be for the prices that they will issue in this September, this October 15th. That proposed decision came out, not a final decision. It still has to be voted on. But proposed decision came out, that's not that favorable to us. And basically, they want to look at longer dated period in setting. And then there's going to be a track 2 where we are arguing for more fundamental, we would like to see more fundamental changes that's more fairer to us in how we model and how we should be accounting for those resources. So there's a whole lengthy discussion there. This was triggered from the last era around this time. We talked about it at the budget setting time too, when PG&E went to the commission and said, stop using your methodology. Commission said, no, we cannot, we'll use our methodology for this year. But for 2025, we'll open up, we'll hear your arguments, PG&E, everyone else who wants to participate. But we reserve the right to set the 2025 rates based on the new methodology. So that's another reason we can't bank on this year's rates, because 2025 rates, what they will use, the balancing account to true up against for 2025 for RA and RPS. Actually, for RA, so far, PG&E later on wanted to tag on RPS. So right now the decision is focused on RA. Track 1, that decision came out. touch a little bit of it in the next presentation. Moving on. Okay, now the stress test. We're getting to the stress test. So up to that was to calibrate you to what happened in the mid-year, why the projections. One was the strong dip in RPS and RA prices, and then we added another year and overall trend in all prices have been coming down. The stress test is basically now to say, well, black swans can happen, right? So prices can collapse even further. So then this is something that we created. Now this is not a market observer, but we actually use what we observe in the market and say, how can we stress these prices further down and try to get them to a lower level. And what I'm going to try to do in these slides is to show you that we've stressed them to what we would call is probably less than 1% chance given current, if we were to model the distribution of prices today on the volatility we're seeing and the prices we're seeing, we would call it less than 1% chance, right? And so on the right side here, we show that the trend in the way we've modeled. The base case is the green and the red is the stress. I purposely took out the scales, the y-axis. These are forward-looking, and we generally don't like our data to be out there in the marketplace because we use this for a lot of very sensitive internal calculations. Okay, so you can see that what we did is basically we took the current markets, stressed it down for full 5-year. Why? So how do I just justify to you that this is a valid thing to do? So we'll go to the next slide. No, sorry, I missed one. So financial stress test. So PCI uncertainty we talked about. So that's another thing. We've customer discount. We've assumed 4% to the end of this year. But for going forward, because this is a stress case, we're assuming 1% discount just to be on the conservative side. And if we're taking out the Carefare discount, all the things that we approved in the mid-year budget continues. It includes the bill credit that was approved, which we'll be issuing in this August. And then there's other potential business and operating risk. There's always regulatory risk, PCI uncertainty being one, as there were others that led us to model a cash draw of basically two months, two of the highest months, which was basically what a case that PG&E was making to the commission in one of our proceedings. So we've kind of used that now going forward as a proxy for other business and financial risks, even though we don't specify all of these other potential, going back to your point earlier, Pat, other business, operating, regulatory, legislative risks. We model it as a one-time draw of 70 million. There's a basis for that based on what we saw in the past, a very incredible risk we were facing. PCI uncertainty actually surpasses that. And we increase our customer bad debt in troubled times. Expect reasonably our bad debt would go up. This is not a big contributor. Generally, our bad debt is a very, very low for us by the CCAs. And now we'll go to the slide 16. Okay, as I said, there's a lot of content here. So model stress price, what we're trying to do, what I'm trying to do now is why should you believe in the stress test that we have modeled? By design, stress tests are meant to be extreme but plausible. Less than 1% chance, but they can happen. They have happened in our careers. Most recent time that I can relate to that had a big impact was the 2008 financial crisis. Prices were forward prices that I explained earlier, were trading very high. Relatively short period of time, oil prices came down, natural gas came down, gas and electricity being correlated came down. So a huge drop, not just in immediate prices, but in the 5-year forwards that we've been trading. So what I'm showing by this is what we've modeled, if we look at it on a relative basis, is actually plausible. So in the next slide, I'm going to show you how natural gas price dropped, and that the percentage drop that we're modeling in the current observed forward prices is within this range that natural gas dropped. You might say, well, why don't I use electricity, which would be more relevant? By this slide, I show you electricity and natural gas, especially in the period we were looking to compare for the benchmark. They were very, very correlated. One goes up, the other goes up. The one goes down, the other one goes down. So, and the reason we do not using electricity is because we just don't have that relevant prices for electricity as we do for natural gas, which is a very, very liquid product, especially at this time of the period. Not for good reasons, but that's what it is. So in this slide, we're showing you that during the financial crisis, the forward, those upper charts, those were the forwards trading for that 5-year period prior to the crisis. The yellow bar is actually the settled prices, the actual realized prices. You can see the forwards relative to the sell prices dropped 50 to 65%. And in the next slide, I show you that the prices remodeling relative to current forwards show a drop of about 47%. You can see if we, it's not, well, we're calling it extreme, but it's plausible. That's what I'm trying to say. Looking historically what we've observed in our industry, remodeling is a plausible black swan that can happen. If it were to happen, and we are kind of in the midst of that. Prices are coming down, as you said, and our financial projections are coming down, but there's always room for further downward correction. Okay, the next slide 20, I'm not going to go through this because I dropped the scale, but look at the recent run-up in RPS and RA, and then the green is the base case. It shows fine. We're showing that decline is reflected in our financial projections. And the model stress test is even more stressful than what we observed in the base case. Okay, so these are all setting you up for stress analysis. Now I'm going to show you the base case relative to the stress case. Obviously, by design, stress case is meant to be more stressful than the base case, right? This is way extreme. So you can see if such a scenario were to occur, you can see, there's not that much of an impact in the near terms relative to the base case. That's again because of the 2-year settling mechanism. It takes, 2 years out into fiscal year 26, 27 when you realize the full impact of it because of the way the MPVs work, CPUC's benchmarking, and the way the balancing accounts work that I talked about very early on in my presentation. And then you can see, this is assuming we're continuing business as is usual. We maintain a 1%, at least a 1% discount. Programs going to continue to be funded at 2%. And the other thing to remember is we have a lot of funds that we have allocated or earmarked for programs. We have active programs out there, but the customer attraction hasn't fully utilized all of that. So we're sitting on close to about $100 million. And the way this forecast takes into account is the way we do base case projections is, and we in the budget, remember we show you reserve projections 2 ways, with and without earmark funds, which you'll also see in our monthly treasurer's report. What this assumes is a projection of how that 100 million in earmark funds get spent over this period. This is still based on this. We will update this for the next budget year, that forecast, but the program spend is still based on the mid-year, which shows by end of year, basically by end of fiscal year 28, 29, we end up using all of that 100 million. Okay. So this assumes all of that remains. We don't pull, so we don't stop the 100 million from the projected spend. We continue to fund programs. You can see we are, even in a stressful case, remember the next 2 years is most critical. A lot of uncertainty. Next 2 years, next year, way more uncertainty even further out, right? So if you look at this, you can see that, our days cash on hand, in the base case stays above 120, even out to September of 2030. Base case, and days cash on hand remains above 300 or around 350 over the next two upcoming fiscal years, next fiscal year and the one after that. We are at slightly above 350. So that's good. In the stress case, the days cash on hand remains above minimum through end of September 2027. Somewhere starting late 28, 29 is, don't change any of our business practices, start depleting those funds. So we look very good, and that's because of the reserves we have built in anticipation of these type of scenarios materializing. I remember all the discussions we've had in prior years that why we needed to build reserves and hold reserves. It is to model the type of scenario financial projections we're seeing. And it's always to give you time to adapt, adjust, and survive, right? That's what the reserves are there for. They're not meant to last forever. They're here. We don't want to be the Lehman. The first one out gets bankrupt and out. We want to have the time to adjust and adapt as other banks had the opportunity going back to financial crisis period. Okay. The next section, I'm going to now recap some of the messages.
5 minutes.
So she has to.
I'm gonna skip this slide, assuming you remembered all the recaps all the things I built up to this case, and that brings me to this slide, which is slide 25, which is our recommendations. We're saying, given that the forecast reserves remaining on base case at 350 over the next 2 fiscal years, and remember 2 fiscal years are very important, more important than the other years, the uncertainty. At this time for this upcoming budget year, we're not recommending any changes in any of our practices we're in good financial position. As in the past, we will set up a budget as we do in September. We'll bring you the draft in August and to the board in August. Incorporate any changes and bring the final for adoption in September, but we'll continue to make any changes that we do on major spending, rate making, and at the December when we'll have more uncertainty. But now that the 5-year outlook is not projections we've had in the past, showing that there's this downward shift, and also because of the way we're adjusting our portfolio, where we're reducing our power purchases, at least on a forward basis, to account for this PCIe uncertainty. Some of the economics that drove it in the past and some of the market conditions that drove it, we can never count on market conditions because there are certain that may not happen in the future. So how should we think about going forward? Well, we think even though there's no, we're in a very good position, even if the worst were to happen. But we want time to work in our favor, right? So this is the time we want to start thinking. Some of the things we may come back to you is maybe, uncertainty means the more financial liquidity, the more reserves. Nothing's as good as a reserve. But another thing we could do is execute a bank line of credit where you still have to pay, something like 300 million to have just a line open, 100 million line of credit open. And then of course, if you draw on it, you got to pay more because now you've got debt on your balance sheet. That's an option we could take. And then internally in our business, we can start reassessing, the way we do discounts. All customers get the same discounts, and the ways in which we can differentiate offerings, the way we do our program design and product offerings. If there's some flexibility and room in the way we should be looking at, we think now we can take that time and start doing some of that internal assessments of these levers, and then we'll come back to the committee and the board with things that may make more sense for us to do or not do, or maybe going forward may make more sense. But it's time to look at it, and that's what we're recommending. And I think I conclude my presentation on stress tests. Any questions? I know I covered a lot.
Questions? Director Mohan has to leave
Should leave at 12, so.
Yeah.
And the budget thing takes.
Budgeting is it's very high level at this point. Just going through the frameworks and the crux of it I've talked here. No major changes. We're going to continue with our past practice. I'm going to show some revenues uncertainty for the next year. Anywhere from 280 to 375, much lower than last year where we were coming in for this fiscal year. year ending September. We're projecting in 523, coming down because of market prices.
Why don't we just take
Why don't
comments
we
on this
go
one and then
see
go to the
the
next
So I
one?
was just giving a highlight.
Yeah, yeah.
That she had to leave.
Yeah, yeah, but she doesn't have to leave for 10 minutes, right? Yeah, so we'll finish this one up.
So any questions on stress test?
No, I mean, you're not asking for any action. You're
Motion,
just hearing about
there is
it.
no motion.
And what we do with the stress test is normally we reassess our reserve levels and the adequacy of our reserves. I think our reserves are good, they're at a good level. Obviously, it doesn't make, normally we say, should we increase them or decrease them? I don't think this is time to decrease them for at all. It will, if I were to follow the methodology laid out, it would by increasing it, which we don't recommend. We'll talk about it in the next as well. There's no reason to increase it because there's no opportunity based on this projection to even build on it.
And then all these stress test scenarios, right?
Yeah, these are
So
extreme but
whether
possible,
it
as
might
I saying,
work out.
we want to be ready should that happen.
I mean, this isn't the same thing, but it's analogous, at least in Los Gatos, to what we do to our whole budget going forward. Stress tests on what our revenues are, what our expenses are gonna be, and, you know, the cone of uncertainty gets bigger as time goes on. Some people have no tolerance for that, and can't be in the future.
And with
But
commodity
you can,
markets
reserves
here,
are huge.
here we're talking about market uncertainty, market price uncertainty.
Right, right,
People
that's a
are
lot
putting down
more,
dollars on these forward prices, but yet at different levels, right? So the uncertainty.
it just has a lot more uncertainty.
Yeah, so that's why we have to have those reserves. That's why we wanted to make sure we talk about the uncertainties we face in our business and in other projections when we present the budget to you. It's not like we can hit it with great certainty. Once we get to the January media budget, yes, certainty we can hit it with and earlier in the year.
No questions, there is no public comment or anything required, so let's go to the next.
Yeah, I think I can cover this very quickly. Look at the slides, I'll let Anu drive it.
Yeah, let's, we literally have 8 minutes or
Yeah,
9 minutes,
it is.
so
This is, you've seen this before, for those of you who are in the finance and for the board before. We'll go to the next slide, we'll just go into the materials. The key reminder here is we're gonna have an early August finance committee meeting because again, as I covered it last time, we don't have meetings in July. June, July is when we prepare the budget and get it ready for you. So we take your feedback in early August. We only have a few days to act on it really. Before we take it to the board in August, and then board sees the draft and we incorporate board changes, then we bring those back to the September for approval, and we'll continue our practice of adjusting rates and any funding scenarios in December when there's more certainty in rates. Go on to the next one. So a lot of uncertainty, we talked about this. And I think given the discussion we just had, there's not much I want to add on this slide. It is basically talks about the PG&E error that came out. We will have an opportunity PG&E will have an opportunity in October to adjust that error forecast. And these uncertainty is so huge that even PG&E, with all the data that they have that we don't have, the forecast is so wrong when it comes out in May versus what gets at the forecast that comes out in the fall. So that's the point. I'll go to the next slide. So this is the main slide of this presentation where even though with all this uncertainty, even though with all this lack of data, even portfolio data that we should have, we did an attempt to do a financial revenue forecast. We came up with a range from 280 to 375. Basically scenarios 2 through 5. And this is taking into account the PCIA uncertainty that I talked about. And number one, the first bar without a number is illustrative. If we were to realize the rates we have currently for 2025 and 2026, you can see our revenues would be somewhere around 500 million. Currently, that's where we are at. But with the error update that PG&E came in, again, they, if we were to get that, it would be a better scenario, but PG&E doesn't incorporate the PCIA uncertainty we talked about. PG&E also, when they do the update, they use market prices as of March. In the March and now we know prices have come down. So our attempt to update incorporates that, as well as an element of PCIA uncertainty. Actually, we haven't modeled, but with the information, we modeled it scenarios 4 and 5. And this is based on an earlier number that came from the energy division of some of the proposed changes that can be. The proposed decision that I mentioned earlier that came out still probably put our revenue projections within this range as of now. You can see that a lot of uncertainty. Next year could be very, very bad or not as bad. This is a final look at it with more uncertainty than what we model in the base case stress test. And that was the main slide. The rest of the slides will roll through.
What is that 13% discount?
Oh, yeah, good question.
I'm looking at that too.
So when PG&E comes out with this error forecast, remember we said we don't have a lot of this data, right? So we use NewGen consultants, CalCCA's consultants model. We use our own prices updates and we use that model. That model is also based on publicly available data. They don't have data, CIA data that I think they should have. We should have. Obviously, they don't have PG&E data. So it's based on that model. And then when the error forecast comes out, we try to calibrate that model to PG&E's model. So we will go back and we'll find that PG&E uses a date like late March. They use market data in their models. We put that data into the NewGen model and say, now let's see if these rates come in. We found a 13% overestimation in our margin. So we said, oh, the model is not 13% wrong. What if we don't know? So we kept the PCIA and PG&E gen rate the same because we don't. Some of that could be the gen rate, some of that could be the PCIA being higher. We don't know. What if we try to take that 13% out? What would that do to our revenues? So that's the 13%. And by the time we do the budget, at least the consultant will have calibrated. So we won't have to. We'll use the more precise number than the way we estimated it here.
Amrit, is this 13% adjustment similar in other years? I mean, you've been doing this for several years.
This is the highest I think we've seen it.
Seems like a lot.
Last year it's been around, usually it's around 10%.
Okay, so it's in that neighborhood, kind of.
Yeah.
Okay, thank
The
you.
most, I think last year may have been 5% or so. I can't remember the exact number right now. This year was large, and part of this is there are some positions that interpretations of PCIA that PG&E is taking in this way they've implemented the error forecast. We don't think they should. I try to show that by comparing those slides. You can see that customers' rates, scenarios 2 and 3 and 4 and 5, customer rates won't change. The billing rate, our rate, what they pay us plus the PCIA, but our revenues go down because that's what PG&E is basically taking a transfer from us to their customers. And that's the way they're interpreting, which is going to be contentious, and we're going to argue that in the proceedings in the year.
So the more accurate adjustment is, our rate will go up, right? Our revenues will go up.
Our revenues will definitely be more than last year. They're going to be in the $500 million range. This estimate right now puts us somewhere between very low end of 280 to 440 to 375. 445 is the PG&E's error, which we think is already outdated because of where the market is moved that date to now. The reserve targets, I actually talked about this. We're not gonna, normally we update reserve targets using stress tests. We're not gonna do that this year. The only thing it imply, actually the target comes in very close to where our target is. When to withstand, it says next 2 years, we should at least have 380 days of cash on hand if the stress would occur. So more of the stress happening in later years. Thank you, Sheila.
Thanks, Amrit. Sorry. you have to rush.
I'll cover the main points,
And I'll call you, I'll look through your
Yeah, absolutely. So it implies, and our current target is at 350, so it's very close for the next 2 years, which is, remember, the years we care the most about. And then for the upper target, we basically set it to withstand the model stress test such that next 2 years reserve stays at 120. We don't fall below 120 under the stress case. The latter 3 years of that forecast period, we don't fall below 90 days of cash on hand. So it implies a larger, hey, to withstand this model stress test, it obviously says, hey, you should build more reserves. So raise the target to 800, which is not, we would not do that anyway, because stress is an extreme case. Stress test is one consideration. We also look at rating agencies' feedback. They're an important contributor in deciding how we set the targets. They've set target around 350. That's where we moved and kept our target using what they've shared with us and what our modeling has showed. And also we are in a downward period. This is not the period to be raising the targets. And even if I were to take it, to raise it, which I wouldn't even recommend, there's no practical implication to the business. Because if you look at the base case, you don't have the opportunity to even build reserves to that. So basically the reserve targets are likely to stay where they are. We're not going to be updating them, and they're at good levels, is basically what I'm saying. Go to the next one. So this is just a reminder that this committee and then ultimately the board has a balancing act every year when it sets the budget, right? What the customer discount rate should be, how much we should be, how much should we be keeping in our reserves, and what else we want to do to advance our mission. Usually it's come in the form of additional funding and set asides for our programs. So that this year will be no different. It'll be more challenging from a financial outlook perspective, but financially we're in a good position. So for the remainder of this year, we are going to recommend, because remember our fiscal year ends in September. So October, November, December of this year falls into the next fiscal year. But we're going to recommend, as we've done in the past years, we don't change our customer rates. And competitive with PG&E, and we continue with the 4% discount and the rates that we have set. Again, this is balancing all the objectives that we have, customer affordability. This is a period when they're facing the high rates. Future years, if our revenues come down, is their rates will come down, right? Because that's what's driving our revenues coming down. Those are the years that there's less need for a customer discount. Those were the basis with which we have designed the current rates. So and our financial projections support that. So we will recommend that we continue to keep our rates for this calendar year the same as we've done every year. We change our rates when PG&E will change in January, which would be, it's a quarter of our fiscal year been gone by then. We recommend we do that. I need PG&E's rate change in January, and I think our financial projection supports that. And that recommendation, for all we discussed before, we'll make at the December board meeting and with the finance committee in November. Again, when we'll have that better data coming from the CPUC as to what the likely rates would be. Okay. And we don't be making any other changes at this point, and go to the next slide. Our power supply expense, with prices coming down, that means we're also we're in a much better position to hit our clean targets. Very pleased to show you there in 2025, we're going to be coming in 106%, meeting our clean target for this year.
That jumped out at all of us, I'm sure. What does that mean, Amber?
So that is our policy. We want to be 100% clean.
Right, but
if you remember last year,
we weren't.
because of all the challenges we had, and you saw the prices, which indicated that why we were having the challenges. The products were just not only prices were sky high, products were just not there. That's that.
So this means we will definitely make it.
Yeah.
Yeah.
So for 2025, we're in a really good position. We tend to cover more than 100% because we have to cover what we call losses. Yeah, so that's part of what the board.
The losses related to the geothermal?
Lines, transmission.
Yeah,
Line
transmission
transmission?
losses. So we have two numbers. The number that we report on the power content label is based on what we sell to our customers. It's called the retail sales number. But what we have to buy at the source of generation. And the two points have losses. And it tends to be about 6%. So we're buying enough clean energy at the source. It turns out that we report a surplus at the retail level.
So the loss is due to transmission losses,
Exactly.
inefficiency,
Yeah.
yeah, perfectly get it.
Yeah, you anytime you transfer energy,
Yeah.
right? So that's what that is.
That's
Generate.
fascinating, thank you.
I like water too.
Yeah,
We have
oh yeah,
losses.
especially if the pipes curve.
Yeah.
So power supply again is always volatile, that volatility that drives prices, will drive the uncertainty to extend open positions we haven't filled for future obligations. We always have those challenges in contracts, any delays, negotiations we have to stretch for, but we don't expect any changes in our power supply methodology, setting the budget for the upcoming year. Again, we will hit our clean target, we project to hit it. Well positioned, so we're not projecting any changes from setting the budget.
So this 106% or 100%, what it means is our demand, we are able to meet, we have the supply, the
We take
clean
that,
energy.
yeah.
Okay. How about the peaks? What happened? That's.
Yeah, that's different. That's
That's
the
different.
capacity that we have to buy reliability
Right.
products or resource adequacy, major reliability procurement order. So we have sufficient capacity to meet our demand in 2025 as well, under the program structure that the California Public Utility Commission sets. So they set a mandate and we have to meet that. We've got that met.
Yeah, that's really something, maybe you could explain in
days, yeah.
the meeting summary. By the way, I love those meeting summaries. They are fabulous. I don't know how other people
The
feel.
meeting of the post-council.
Yeah, yeah, they are very, very helpful. But anyway, if you could sort of, that's the kind of thing people want to hear. If you could sort of explain that, the 106 versus 100 and why we need it's almost like friction losses or something, isn't it? Yeah, that's fascinating. I think my geeky constituents would love to know that.
Yeah, maybe we can also include that as part of the, we're putting together some like FAQs for our 2024 power content label, which will go out in August. So we were gonna put some talking points for board members as well, because we've had a couple of board members ask for them. It'll be the first time that we show that we're not 100%.
Why you have to be above 100% to be 100%.
That too, but yeah.
Yeah, that's amazing.
Go to the next slide. So other costs, one of the other areas we focus on is our staffing. As you know, the media budget, we added 5 new positions. Going forward, there are areas we always have need for that we'll be looking for, but we don't foresee increasing that target for this budget year, or for the upcoming budget that the board will approve in September. We will, if there is any adjustments, we can relook at it at mid-year level. And of course, there any emergencies happens, we have the personnel authority and the CEO where we can make adjustments. If there's any emergency need that should arise, but we don't see any changes in staffing for the coming budget approved in September. For adjustments, we're recommending we continue the methodology we've used in the past, adjusting for cost of living adjustments, where we've been using 6 months of this Bay Area CPI, which currently is at as of April or so, it was at 2.45%. We'll have data through the first 6 months, I think, by the time we set the budget. So we'll update that and use that precise number. We should be around that number. And then there's always on top of cost of living, there's merit adjustments, and that's at the CEO's discretion. Any merit or promotions must be warranted. It's about the main thing to add to that slide. Yeah, and that's a very short presentation, so this brings me to the end. We're just talking about what to expect when we bring the budget in August. So we will again continue to look at the error forecast that came out, the PCA decision that came out. And then we'll have a draft budget for your review in August. We will probably seek out for your availability soon. Need that right away as soon as August hits. We need that meeting. We target to get it before the second Wednesday, which is when the board meeting is. The recommendation to take to the board. And that's part of the reason we have this budget framework. So if you have any big assumption changes you want us to look at, we can.
Do you want to poll us today? While we're here?
Do that?
Is that?
That should be okay, but two of them are not
Two
here.
people aren't here.
Yeah,
Yeah, fine.
so maybe, yeah.
Agenda.
I could just get direction to get some dates from you and reach out to the
Yeah,
remaining two members.
or you can send out the email today itself, that way all of us can
Yeah.
look at the.
I think that was it, right?
Yes.
I would like it to be after the 3rd.
Of August.
Okay, so thank you for listening through that. That was a lot of material. Some of it was review, but I thought it was a good time to go through all of that because of changes in the financial projections. Somewhat different than what we've shared in the past.
Any questions, comments?
I just always make this comment, I'm gonna make it again, and that I'm really glad to see that we're hiring some people. I think that particularly with all the uncertainty and the potential downturns in the economy, this is a great time for government hiring. You get a lot of good candidates, and so it's good to take advantage of it. So I'm really all for the staffing up and, whatever your discretion is about adding temporaries or interns or however to kind of grow the bench. I think this is an opportunity. Hopefully there will be better economic times coming down the pike in the future where that you won't have as much of a large pool of people who are interested.
Great.
Any other comments?
Oh, anyway, this looks great to me.
Yeah, this looks good, and then I really like the usage of reserves. And then to plan for stress testing, right? That's really, really good. No other comments. The last item is committee and staff remarks.
Just confirming there was no public comment for that item.
Yeah, there was
Oh,
no
yeah.
public comment. So from my perspective, thanks a lot, Amrit. All the three were complicated financial
I should
things.
mention there's staff that work behind this. There's Scott, there's people in Scott's team. Mention some names, I'll end up missing other names, but I'll mention some names. Alex, who did a lot of modeling work, and he actually came up with a new model. I don't know if he's listening to this meeting. It made it much more easier for us now to do multiple scenarios quickly. And then others that are IDAS, all the revenue projections and all the iterations, he always works with me as late as needed. There's Anand in the Scott's team, who's also produced all the modeling of all the, especially the energy side of it, and he's brought a lot of that in-house. And then there are people in the procurement team, like Owen, who also helps us a lot with the data modeling side. Our procurement portfolio, which is 90% or so of our expense.
On the prepay.
In
Yeah.
prepay, I have Zach. Zach also really helping us backends as well.
This is a really amazing presentation. All the three were complicated.
So I missed some people in the budget. I have Karen, manager of finance, who helps us project manage and guide us through this whole process. And so it helps her and so on. And everyone in the organization actually works in the risk through the ERM framework that we have. We actually take down to all the staff level and bring it up at the management level and go to the strategy focus area that Monica's gonna talk about in August. Yeah, the directors and everything. And these two wonderful ladies
Yeah.
always get the materials late. Because we have to wait for these CPUC decisions, they're always last minute, and then once you've done the analysis, that something else will come up. Well, I think balance, we have to cut it off.
Right.
Close the meeting.
Thank you very much. No other comments? We'll adjourn the meeting at 12:14. Scott, is that the cricket ball or the shelf?
Wow.
Nice.
Yes.
Yeah.
I've been down to Trinidad and Tobago many times.
Yeah.
Wow.
Ryan Lara.
Oh, wow, yeah, I was there for his last match.
All right, excellent.
And I'm
Okay.
curious if Michael's too